On 25 points gone. Nikhil Ranka, CIO, Equity Alternatives. Nuvama Asset Management is now joining in. Thank you very much, Nikhil, for joining in. In this sideways grind, what fresh positions are you taking now?
So, Rima, I would say markets are basically looking out for triggers. If you take the precedence of other emerging markets, India has underperformed MSCI Emerging Market Index by almost close to 25% this year. And if you look at other emerging markets, a rally has started whenever a trade deal has got finalized with the US. Because then there is certainty, people will fine-tune their earnings estimates, and accordingly, once the uncertainty is out, those markets have performed. In the case of India, very specifically, two things have happened. One, we have not yet been able to finalize the terms of the trade deal. And the point is the time is clearly running out because Christmas is the peak season for US. And if we are unable to do it in the next 2 months, for a lot of the exporters on the textiles or the garment side, the peak season will be behind them and this year will get washed out. So my sense is for the markets to break out of this 24,500 to 25,500 range, we will need some sort of triggers in the sort of finalization of tariffs with the US. And then a risk-on rally should come through. Even in terms of valuations, if you look at it, although we would have seen 1 year of time consolidation, on an absolute basis on FY27 earnings, we are not very, very cheap. We are still closer to 19.5 times FY27 earnings, which is where the median multiple is. So it's not that we have become extremely cheap on valuations in that sense.
Nikhil, hi. You've had a cautious view, and I think what you're saying is that return expectations themselves need to be reset to perhaps 10%, unlike 12, 13, 14% that we're used to expecting from equities. So, Nikhil, just tell us, since you have a more cautious stance and you mentioned some of the other facets about, for instance, tax collections maybe running behind estimates. How should one position the portfolio then? Are you cutting back from positions on the capex side of the market? And if yes, in what part of it? For instance, defense, look at it, HAL today. They're still announcing mega order wins. On the shipbuilding side, big announcements coming in from the government. So where are you cutting back on the capex or industrial side?
So if you actually look at the fiscal match, at the start of the year when the budget was announced, the direct tax collections were pegged at close to 25 lakh crores, which meant close to 12-13% growth for FY26 over FY25. If we look at the first 6 months of the year, we are tracking somewhere close to 8% in terms of direct tax collections. And assuming that, we continue with the same number for the rest of the year, you could have 3-4% slippage on the overall growth of tax collections. Which would mean that there could be 1 lakh crores of hole that comes from the direct tax collection side. On top of it, we have the GST cuts that have been announced and got implemented from 22nd September. If you look at the government estimates itself, the number was put somewhere closer to 45-50,000 crores. So if you put together 1.5 lakh crores of revenue deficit, then we are looking at close to 40 bips of additional fiscal slippage for FY26. Now, there are two ways to do it. One, government increases borrowing, which would mean that there will be crowding out in the second half, which could put pressure on yields. Or the other way to then do it is cut back on the capex side of it, so that 10.5-11 lakh crore number. If there's some sort of 10% slowdown in that, then probably, you will be able to manage the fiscal deficit much better in that sense. So therefore, my sense is there could be some sort of pressure on capex names as we move into, later half of the year if the government spending doesn't come through. And therefore, my sense is given the rally that we have seen in a lot of these defense names, this could be an opportune time to take some profits in those names.
Hi Nikhil, good afternoon, good to see you. Nikhil, what's the view on tech? Things were looking actually like they were bottoming out and tech was said to catch up. But now suddenly over the weekend, Mr. Trump, he's having some issues with that H-1B visa. Well, most sell-side notes suggest that it's not going to be such a big impact. We have a lot of companies as well that joined and said it may not be such a big impact. The problem is the intent. And that's what's dented sentiment. And that's why the index itself is down 5.5% for this week. Do you think you would be looking to buy into this dip, or do you think there's too much of uncertainty and no growth, so you'd rather stay away?
So Nigel, if you put two, three things have happened for tech. The first is, the impact of AI in that sense. If you read some of the research reports that have come out, what they have basically put is that there could be 300 bips of deflationary pricing pressure on tech because of AI. That is one of the headwinds. So you will have to have much more volume growth to compensate for that. The second part is if you take the H-1B visa impact, the number is close to 1 lakh crores, but typically the tenure is close to 6 years for an H-1B visa. So on a per year basis, the impact is just $16,000 and the numbers are very small. So if you look at, the commentary from a lot of companies, nobody is expecting a hit of more than 50 to 100 basis points on margins because of the H-1B hike. And some way they can mitigate through that through lower salary hikes for employees. However, the key concern that now remains for the street is after H-1B visa part of it, does it do something on the higher act? Because there the measures are much more draconian. He's talking about a 25% tax on outsourcing. So everybody is therefore waiting for the dust to settle to have some clarity on what shape the final tariff negotiations with the US takes place. Because valuations anyways have become very, very lucrative now. Most of the names are trading 2 standard deviation below mean. But so to say, there's no trigger for the stock prices to move till we have clarity on tariff negotiations. So we will see a very decent rally. The same thing what happened with auto stocks post GST cut. The only event that we have to watch out for, when does the tariff negotiation come through with the US? And I think then tech will start performing.
You actually think this higher act, which imposes a 25% outsourcing tax, will come into effect? Because we've had these threats in the past. They've been introduced many times, in some form or shape. But they've not been converted into a law or passed through as a legislation. Do you think it's different this time, given the tension between India and US? And finally, after you just wrap up the discussion on IT, if you had to pick one sector as a secular trade for the next 3 to 5 years, which you're most bullish on, which sector would that be from here on?
So Rima, if you look at it, in the initial 3-4 months when this tariff thing was happening, services were kept completely out of the gamut of tariffs in that sense. And then suddenly we had this H-1B visa issue coming up. And then that created a sort of uncertainty for IT names. And then, talks of higher act also started coming. Given the way situation has been so fluid in the US in the last 5-6 months, you cannot rule out anything completely, I would say. And that is exactly what the street is also getting nervous on. I would say this will be a less than 20% probability event that something of this sort comes through. Because, the margins for most IT players itself is in the range of 12 to 14%. So if you start putting a 25% tax, ultimately it will be the US companies who will have to bear that. There's no way Indian companies can absorb that sort of cost hike, which would be detrimental for, jobs over there as well. So my base case is that it will not come through. It's only the uncertainty which is keeping the valuations a bit capped for IT companies. Given the way, things are panning out on the global side, I would say cement is one sector where, we've seen sort of GST cuts happening, almost 30 rupees of reduction per bag should happen. And that's one sector which is completely insulated, so to say, from the global uncertainties. So in this sort of scenario, I think a lot of fund managers would want to hide in cement. And my expectations is that sector should do well over the next 2-3 years. We are very clear, given the way consolidation has happened in the industry. The industry is now 60-65% in the hands of 2 players. Pricing power will come for cement companies. And, what we are seeing today, closer to 800-900 rupees of EBITDA per ton, that should move closer to 1,100-1,200 rupees over the next 18 to 24 months.
Okay. All right. Nikhil, thanks very much. Great perspective. Good to have you on the show today. And we look forward to more conversations. Thanks for joining in. Well, with that, just a quick glance on the market because the weakness is really telling. Look at this. I mean, now the market's picking up momentum on the way down. So the 20 DMA is gone, the 50 DMA is gone, and now the fall is